Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, the beauty of mathematics, part 36. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So we generally provide these updates on the first of every month. Sometimes it comes a little bit later on the second, but the whole idea is to understand where the assessment is of the entire asset class as a whole on a monthly basis with respect to the fair value logarithmic regression trend line, which, as we know and as we've said before, is a monotonically increasing function. Now, the whole idea behind a monotonically increasing function is the idea that it only goes up, right? That's the idea. Is it dubious? It is, but that's sort of what we do around here. While the fair value of the asset class, based on, say, adoption through time, would be seen, in my opinion, to more or less only go up, that doesn't mean that the asset class actual market capitalization only goes up. And in fact, there is an ebb and flow to the cryptocurrency asset class from being overvalued and then being undervalued. And we sort of just go back and forth from one market cycle to another. You can see we went from undervalued in 2010 to then being overvalued in 2011 and then being undervalued again in 2012, overvalued in 2013, undervalued in 2015 and 2016, and then being overvalued in 2017 and even for a large part of 2018 until we got to that final capitulation. And then 2019, we saw ourselves get back above the fair value for a very brief period of time in mid 2019, although it was relatively short lived, as we then faded the rest of the pre-halving year and then ultimately rallied into the red trend line again one last time until we got the recession after we had the uninversion of the yield curve last cycle. This time around, you can see that we got back into the overvaluation territory. However, we were unable to actually go all the way back up to the top trend line, arguably due somewhat in part to the macro headwinds that faced us and also the quick unraveling of more traditional markets, right, in the S&P 500. Now, the interesting thing that we always have to remind ourselves of is that during periods of undervaluation, it always has historically been a good time to DCA into the market, right? When it's overvalued, the idea is that you DCA out of the market. That's the general idea, right? And it's always been that simple. You know, you can go back 30, this is what, part 36, look at the last 35 videos on it, right? That's what we've always said, is that you try to DCA out based on historical data when it's overvalued and DCA in when it's undervalued. Now, there's a couple caveats to this that I think we should talk about. One of which is that when we go into overvaluation territory, it doesn't mean that, you know, it would merit just selling everything because it's technically overvalued. You can see that we can spend years in this overvaluation territory. Years. So if you were to come in say, you know, December of 2020 and said, all right, well, we're overvalued, that means it's time to sell, you would have basically just missed out on this overvaluation period that occurred for the next, you know, couple of years or so. And so in the same way, when you become undervalued, it doesn't mean that you need to immediately bet the family farm, right? Because history also shows us that we can be undervalued for relatively long periods of time. Now, I have argued many times that the pre-halving year for Bitcoin is a half up and half down year, right? Where you wreck both sides. That is the general thesis, right? We've talked about it many times. The whole idea is Bitcoin spends about half of its pre-halving year going up and about half of its pre-halving year going down. Now, so far, we've had 4 green months and 1 red month, which would lead me to believe that likely, I would say 4 or 5 of the next 7 months are likely going to be red. But that doesn't mean you can't have 2 or 3 more months potentially of green at some point, right? You could see that. And that's what we historically have seen. We typically see about 6 green months and 6 red months, or plus or minus 1. I mean, we don't really have a whole lot of data to compare to, but at least in the pre-halving years, that is what we've seen. In the bear market years of 2014, 2018, and 2022, we more or less had 8 or 9 red months, both in 2018 and in 2014. And then again, we also had about the same in 2022. So I'm just going off the historical data that we have that suggests that during the pre-halving year, you spend about half the time going up and half the time going down. And because of this, it leads to a relatively sideways market. Okay, now when you're living through it, it often doesn't feel like that, right? It can feel very bullish at times. It can feel very bearish at times. If you were to look at 2015, you probably would look at this and say, well, it just went sideways, right? You might say, oh, easy year to navigate the market. The market just went sideways. But that's not necessarily a fair assessment to the people who were living through it. You know, I remember 2015, and Bitcoin rallied about 80% from the low. I don't know exactly what the total market cap rallied, but I mean, it was still a fairly substantial rally. But again, Bitcoin rallied 80% off the low. Most people today would say, well, an 80% rally or even 100% rally should not be characterized as sideways. But I imagine we also would have no problem looking back at 2015 and characterizing it as sideways, right? In the same way, you can see that the asset class fell below the fair value logarithmic regression trend line back in the summer of 22. That did not mark the low of that year. I know a lot of people were hopeful that June was the bottom, and we were quite adamant that we would go lower at the end of the year. This is what we said many, many times, that we would likely go lower at the end of the year, and that could be the bottom, right? It doesn't necessarily have to be, but it could be. And one of the things that I think we have to consider is that in both cases, in the last two cycles, the real move to the upside that actually took us to new highs did not occur until we tagged the lower green logarithmic regression trend line. Okay, you can see that it happened in March of 2020, and it also happened in Q3 of 2015. Now, with that said, one of the things that you've probably heard me say quite frequently is that I would expect one more scare in Bitcoin sometime in either the second half of the year or in the early part of 2024 if we're going to continue to repeat this very cyclical behavior. Now, I know some people are more of a proponent of sort of shifting the cycles around in terms of where they peak and whatnot. And hey, I think it's important to consider all possibilities. Okay, so we should consider all possibilities at all times. Markets show us time and time again as to why we should continue to do that. But at the end of the day, we had a peak at the end of 2013, the peak at the end of 2017, and then one at the end of 2021. We then had it followed up by a bear market year. And then typically following the bear market years, you can see that the market just tends to go sideways until we hit the fair value or the lower regression trend line, okay? Now, in 2015, we did not go back to the fair value logarithmic regression trend line, okay? We did not. In 2019, we did. So there's a difference here. In one of these cycles, it was relatively dull, and Bitcoin only rallied, not even 2x off its low. But in 2019, Bitcoin rallied 4x off its low, and we saw a much larger move to the upside. In both cases, the asset class eventually came back down and tagged the lower regression trend line in both cases, okay? The only difference is one of them, it was mostly just sideways until we went into it, and the other one, we rallied. We faded the second half of the pre-halving year, and then we rallied into the recession only to come back down and get relatively close. I mean, it's not an exact touch right here, but we got relatively close to the lower regression trend line, okay? So when we think about this, we have to think about, well, what are the similarities between now and the last two cycles? Arguably, I would say, at least so far, once we fell below this fair value regression trend line back in June, this cycle so far looks more similar to 2015, does it not? Right? You can see that the fair value, the actual market capitalization with respect to the fair value has been sort of slowly going away from it. Now you might say, well, Ben, this doesn't make any sense. Um, why would we have been getting further away from it over here when we know that the asset class was going up slightly? It did go put in a double bottom in August of 2015, but remember, the fair value is a monotonically increasing function. So again, as the asset class matures and as we have more adoption, we expect the fair value of the asset class to go up, right? That is the general expectation. It's just that if the asset class actual market capitalization does not keep pace with that fair value, then it means the asset class as a whole is becoming increasingly undervalued. Okay? Think about it like this. We got closer to the lower regression trend line in March 2020 than we did in December 2018. However, in December 2018, we technically saw a lower market capitalization for the entire asset class than we did in 2020. But the reason why we were more undervalued in 2020, and arguably an important part of us seeing a major rally into the overvaluation territory, is because the fair value was so much higher. In late 2018, the fair value, when we hit this low, was approximately 154 billion, and the total market cap was at 100 billion. Over here, the market cap was at about 160 billion by March of 2020. But if you actually look at the wicks, we actually did go much further down on if you look at total market cap. Okay, we actually did go quite a bit further down. And why don't we just go take a very quick look at it rather than trusting what I'm saying? Let's go take a look at just how far down it went. You can see that it came to within about 15% or so of the prior low, right? About 15%. And you can see that it went back down to about 108 billion. And on here, you can see it was around just below 100 billion. So there certainly was a higher low put in place, but because the fair value had gone up to 355 billion compared to where it was back over here, which was only 154 billion, we were technically more undervalued. Okay. And that is ultimately what, I think what we're trying to convey is that the fair value of the asset class goes up no matter what, right? Because, again, like not everyone's going to believe that because you either believe the crypto narrative or you don't. And if you don't, then you're not going to believe that. And if you do, then you probably do believe that, right? But even if you believe that, which I do, I believe that the asset class's fair value does increase monotonically as a function of time. Even if you believe that, it doesn't mean that we can't go through periods of undervaluation, just like we're in right now. And again, right now, the asset class is coming in undervalued to the tune of about 45.53%. Now, I've said many times that I would expect us to hit this lower regression trend line before we get a sustained move into the overvaluation regime. I have seen plenty of comments, and useful comments saying, well, since we didn't go to the top over here, do we have to go to the bottom over here? I will remind you, right, in financial markets, nothing has to happen, right? We could go back up without going all the way back down. We could go below the lower regression trend line, right? There's all sorts of things that could happen. So please be aware that there is always a path for any type of scenario, as long as it's, as long as it's somewhat realistic, right? We're not going to sit here and say that it's going to go, 10x or something in a short time. But there's always a reason to at least entertain various outlooks, okay? And all I'm trying to do is say, look, I've lived through, these cycles more than once, right? Just a few times at this point. And normally what happens is that the market gets somewhat boring until really either the end of the pre-halving year or the beginning of the halving year. That's what normally happens, okay? So with that in mind, one thing to consider is that in 2015, right, in 2015 and 2016, what was going on with the S&P that allowed crypto to come all the way back down to the prior low? And then what was going on in 2020 that allowed crypto to more or less come down to the prior low? Some cryptocurrencies put in a new low. Some cryptocurrencies did not. For instance, the blue chips like Bitcoin and Ethereum did not put in a new low. But a lot of the altcoin market did put in a new low. So what was going on in that scenario to sort of really justify the crypto asset class sort of going back down. Well, we know what happened in 2020. I mean, you'd have to be living under a rock to not understand what happened in 2020. We had a massive capitulation by most financial markets, and cryptocurrency went back down, right? We went back down and sort of retested the prior low, maybe a slightly higher low for some assets, a slightly lower low for others, but we went back down. But what else did it correspond to? It corresponded to a recession. That recession did not occur until early 2020. So if we were to repeat this same type of behavior, if you remember, we had an inverted yield curve in 2019. Okay? So we had an inverted yield curve in 2019. It didn't stop the S&P from climbing the wall of worry for a long time, but we still ended up getting that recession after the uninversion of the yield curve. Now, in 2015, what happened, right? You can see that the S&P fell off a cliff here in August, but we did not have a recession, right? It was just a correction. We came close to a recession during this time period in 2015 and 2016. We came relatively close to a recession, but it did not actually materialize. And so in both scenarios, you had a scare in the S&P 500, which ultimately led to crypto getting sold off once again. In both cases, it happened before the halving, right? So you had a major sell-off and a retest of the prior lows in Bitcoin and the total market cap, approximately, both in 2015 and in 2020. In 2019, we had an inverted yield curve. In 2015, we did not. Okay, so if we go take a look at the yield curve, and let's just look at Treasury yield spreads on the 3-month and the 10-year, you will again remember that we did not have an inverted yield curve in 2015, but it did not stop people from worrying about a recession, and we ultimately were able to avoid it. In 2019, we had an inverted yield curve, and when it uninverted, we were not able to avoid a recession. Right now, we also have an inverted yield curve. And at some point, we will have the uninversion of this yield curve. And it's upon the uninversion that you have to deal with the possibility of a recession. And this is, I think, where a lot of people can kind of get disenfranchised with the idea of even talking about recessions. And we've seen this for the last 18 months. People constantly say that we're in a recession, but to say that is completely ignoring the strength of the labor market. Okay? But if we think about the context of history, we need to understand why would we go into a recession, right? What would cause the yield curve to uninvert? The yield curve is only going to really uninvert if the Fed changes their monetary policy, right? If they go back to being a lot more dovish. But that's likely not going to happen as long as the labor market remains tight. So as long as the labor market remains this tight, it is possible for risk assets, especially equities, to climb the wall of worry. That's exactly what happened in 2019. We had an inverted yield curve, and then it uninverted, and equities just climbed the wall of worry. Eventually, we got the recession. Okay, so again, today you're seeing a very similar thing happen, right? We have an inverted yield curve. The S&P just continues to climb the wall of worry, and until you see the labor market start to deteriorate, then that is the expectation, right? It's called climbing the wall of worry, right? There's one thing after another to worry about, whether it's the TGA, the student loan repayment, the debt ceiling, the regional banking crisis that we had in March. There's always going to be something to worry about. We need to recognize that. There's always going to be something to worry about. But as I've said before, until you see, I've said really one of two things. It's either the reacceleration of inflation, which I don't really see happening right now. I mean, core PCE has been sticky, but headlines been coming down. Or you see the deterioration of the labor market, the markets can climb the wall of worry. Now, there are other things that could cause major corrections. You could have geopolitical events. There are other things, but those are the two main things that I think we need to consider. It's just inflation, if it reaccelerates, and the labor market. And probably the labor market is much more important than inflation in terms of trying to understand what the S&P is likely doing from a risk-off, risk-on point of view. So going back to the total market cap, again, the idea is scaling in when the asset class is undervalued and scaling out when the asset class is overvalued. Now, you're probably sitting there thinking, well, hold on a minute, Ben. You've been saying for a long time that the altcoin market is too risky. And I still agree with that. Not necessarily in terms of the idea that they won't go back up if you hold them and if you hold them for the next 2 or 3 years, but more so I find them risky in from the sense that they are likely to bleed against Bitcoin. Okay? One thing to remember, as I've said, is that Bitcoin could put in a double bottom, it could put in a higher low, and still the altcoin market could put in new lows. If Bitcoin were to put in a new low itself, then where does that leave the altcoin market? So again, that's why I continue to say the altcoin market, in my opinion, again, not financial advice, right? But the altcoin market, in my opinion, is too risky because they're bleeding against Bitcoin. It's always, what are they doing with respect to Bitcoin? Their USD valuations are largely irrelevant to me. And I know that sounds weird, to a lot of people, because that's all they ever care about is their USD valuations. But again, if Bitcoin goes up 100% like it has in 2023, and the altcoin market is only up half that, let's go take a look, right? Total 3. How far up is the altcoin market this year? 22% right now. 22%. Where is Bitcoin? How far is Bitcoin up from the lows? 75%. So again, that's why I say the altcoin market is too risky, is that they're generally bleeding back to Bitcoin. And this is the phase where that happens, where the altcoin market just gets chopped up and people slowly watch the Satoshi valuation of their portfolio deteriorate because they keep YOLOing into the altcoin market, but the altcoin market liquidity keeps bleeding back to Bitcoin. It's that liquidity that bleeds back to Bitcoin that eventually, theoretically, sometime after the halving, can provide fuel to ultimately go up. But in the same way, as the liquidity from the altcoin market goes back to Bitcoin, at some point we reach a level where there's not sufficient liquidity in the altcoin market to keep Bitcoin elevated, and then we get that final scare, whether it's the end of this, sometime in the second half of this year or early next year. It's hard for me to say. And I mean, again, nothing's a guarantee, but that's what we saw 2 cycles ago. We had that final move back to the downside where a lot of altcoins put in new lows. Bitcoin just put on a double bottom. This time, or last cycle, we had a higher low by Bitcoin, but a lot of altcoins put in new lows. And again, this occurred about 14, 15 months after this low. This was December 2018, and this didn't really happen until March of 2020. So if you were to have a similar timeline on this cycle, this was November, so it could still be as late as February of 2022 and still fall in line with the general idea of the cyclical behavior of crypto. And normally, it's that secondary scare that gets people to really, lose faith in the entire cryptocurrency market as a whole, just before you get a real sustained expansion into the overvaluation territory. Okay, again, this is just what we have historically seen. Okay, I can't really comment on every possible outcome. Of course, there are potential outcomes that differ than specifically what I'm saying, but in general, the altcoin market bleeds back to Bitcoin for the most part during this phase of the cycle. At some point, there's not sufficient liquidity in the altcoin market to support a sustained rally anymore by Bitcoin. It then falls back in, crushes the altcoin market. We hit the lower regression trend line, and then we go back up into a phase of expansion that sends us back into the overvaluation territory. If history is any indication, the sustained move to overvaluation territory is likely not going to happen until 2024 or 2025. Last cycle, it occurred in, basically late 2020, early 2021. The cycle before that, it occurred in about mid-2017. The cycle before that, it occurred in early 2013. So I really wouldn't expect sustained levels of overvaluation until late 2024 or early 2025 at the earliest. It doesn't mean that you can't have a 2019-like rally where you go slightly above it, but it wasn't a sustained move. And so even if that were to happen this time, I don't really think it would be a sustained move until we really work out the yield curve issues that we have to deal with, which is the same thing we had to deal with last cycle as well. I mean, we had the inverted yield curve last cycle, and the market climbed the wall of worry, and then the market faded back in. We rallied into the recession, and then we capitulated. And even though we capitulated as late as early 2020, we still rallied 20x or more over the next year. So that is kind of like my baseline assumption, is that the pre-halving year, you get these types of sideways markets where you kind of spend half the year going up and half the year going down, right? Half the year up and then half the year down. You eventually get your final scare, whether it was in the early part of the halving year like last cycle, or whether it was in the latter half of the pre-halving year like the cycle before. It's hard to know exactly when it happens. Not that it has to happen, but that is what we've generally seen. Now, the other way that we measure this is we take the percent difference between the market cap and the fair value regression trend line. And if you do that, you get something that looks like this. And what you'll notice is that with the exception of 2012, we tend to reach undervaluation territory lower than where we currently are. I mean, you can see that this was, 60, 65% undervalued depending on which one you look at. Right now, we're about 45% undervalued. Now, we don't have to have price go lower per se for us to become more undervalued. Remember, if we were to just go sideways into the regression trend line, we would become more undervalued, right? Like in 2015, we were going sideways with up and down. I mean, there were periods definitely where it went down, especially in July and August of 2015. And you can see this sort of fell off a cliff. Now, we sort of bottomed at a very similar level as we did over here. And we rallied for, half the year or so, but ultimately we came back in and we hit that deep undervaluation territory corresponding to the lower part of the regression trend line, right? You can see that happened back over here in 2015. And we didn't really kind of come out of this mess until the latter part of the pre-halving year. Right now, this looks very similar to me, right? To me, 2023 looks more similar to 2015 than it does to this cycle. However, I think we should say that there's probably a little bit of, there's probably elements of both. It's not really identical to either one. There are some similarities between 2019 and today. There's also some similarities between 2015 and today. And so that's something that I think we have to try to reconcile as well. And if you're not familiar with what I'm talking about, just go take a look at the year-to-date ROI. And just hide everything and just look at the pre-halving years. You have 2015, 2019, and 2023. And I mean, you can see that 2023 so far has been a somewhat tempered version of 2019 now that we've gone below it, but it's also been a more impressive version of 2015. And the way that I think we could look at this in a more compelling way is to average out 2015 and 2019. And when you do that, you get something that looks like this. So this is 2023, and then this orange line is an average of 2015 and 2019. It's because of this average that I've stated many, many times that the range of price action for Bitcoin in 2023, my best guess, again, I can't know the future, and there's a good chance we go outside of these bounds, but my best guess for price action in 2023 is for Bitcoin to stay above $12,000, but no higher than approximately $35,000. Now, the reason I came to those numbers is if you take an average of 2015 and 2019, we went as low as 25% below the yearly open, and we went as high as 2.1x above the yearly open. That would mean, if you were to look at where the yearly open was for Bitcoin, if you were to go look at say, these 12-month candles and just figure out where the yearly open was, it was at 16,530. So if you have a 25% move below the yearly open, that gets you to 12,000. If you have a 2.1x above the yearly open, that gets you to around 35,000. Okay, so that is one of the reasons why I've said I think price action will fall between $12,000 and $35,000 within the year of 2023. Now, I know a lot of you are thinking, you're like, well, what's been smoking to think that that's helpful, right? I mean, who cares if it's such a wide range? That's why you're here, is it not? You're here because of that volatility. If it were not for that volatility, I imagine many of you wouldn't even be watching this video. Again, if you go look at modern portfolio theory, expected annual returns from a portfolio consisting of Bitcoin and Ethereum suggest that our expected annual return is somewhere around 65% or so, plus or minus 75%. Meaning, yeah, like there can be years where you see 100, 200% returns or more, sometimes much more, but there's also years that you can go down 80%. So, yes, it is a wide range to say that Bitcoin should spend the year between $12,000 and $35,000, but that's also what the data would suggest is a likely range, right? So I think that we have to be aware that this volatility is what brings us here. It should not be scoffed at as, well, that's too large of a range. That's what we saw. I mean, that's what we've historically seen, that Bitcoin can be range bound between fairly large numbers, right? Take a look at even 2015, which looks like a fairly sideways year. Bitcoin rallied off the low here 90% or so. I said 80% earlier. It was around 90%, in fact. And then it came back down and then rallied up another 40% and still ended up putting in a double bottom. So, there's certainly these things that we have to be considerate of. And I've said before, right? I mean, we've made the comparisons between this cycle and 2019. I think you can make evidence in both directions. I think there's some evidence to suggest the yearly high is in. There's some evidence to suggest that it's not. To me, if you look at a lot of the moving averages and whatnot, we are starting to show some weakness, right? The momentum is starting to die down for Bitcoin in some areas. The main counterpoint is that the dominance of Bitcoin is still so low. And normally it takes a rally by Bitcoin USD to really break the range high. It doesn't have to be. I mean, look, this rally over here by dominance occurred when Bitcoin USD was going down, not up. I mean, this was when Bitcoin was going down that this rallied. So I don't think you have to have it. I don't think you have to have Bitcoin USD going up to necessarily break the range high, but that's actually what happened in 2018, and it's what happened in 2019. It was on a Bitcoin rally, and it was only once the range high, the dominance was broken, that then Bitcoin actually came back down, and then you had sort of the down part of the bear market year or the pre-halving year, right? So there's certainly evidence in both directions. So how do you navigate that? How do you navigate it? On one hand, there's the only doom and gloom crowd. On the other hand, there's the moon boy crowd, and it's easy to get drawn into either of them, right? And it's easy to want to say, well, there's compelling reasons to think both sides are right. I sort of think that in the pre-halving years, you get both sides wrecked. That's what my own experiences teach me, is that I fell in 2019 for the rally, right? Like I thought that things were good, and then we just came back down. And then in 2015, we rallied on up, and I was pretty excited. And by the end of 2015, I didn't know what was going on. I'm like, well, everything seems bullish. Why are we going back down? So this is just what my own experience has taught me. Markets do evolve, so I'm not saying that it has to play out the same way, but in general, that is what my own experiences have taught me, and that's why I've continued to say that in the pre-halving year, normally what happens is you go half up and half down. Now, there's something else I want to mention. I don't know, we're going pretty far beyond what we normally talk about in these videos, but I want to do a good job of trying to communicate all of my thoughts. You're probably thinking, well, Ben, the S&P is going up a lot right now. So won't that drag Bitcoin? If the NASDAQ and the S&P are rallying, can't that drag Bitcoin up to near its prior highs? Well, one of the things you have to also consider is that Bitcoin is further along the risk curve than things like the S&P 500. In fact, when Bitcoin rallied in 2019, 4x, right? You should note that the S&P at the time was actually putting in, right, new highs. Okay, so the S&P was already at a new high in April of 2019. Whereas this time around in April of 2019, of course, we're not at new highs. We'd have a long way to go. So I think in that regard, the S&P is not as strong as it was back in 2019, and by association, Bitcoin has not been nearly as strong, right? By June of 2019, Bitcoin was gearing up for its final move, which took it up 4x from its yearly open, or from the low, anyways, 4x. And I don't really think Bitcoin's going to be going 4x from its low this year. Okay, I mean that would put Bitcoin at like 60K. I don't really think that's happening this year. If I'm proven wrong, I'm proven wrong. But like I don't think that's happening this year. So we have to remind ourselves that the S&P continued to rally. Now here's something to consider. You're probably wondering, well, why is the S&P going up week after week after week, and then Bitcoin's just kind of sitting here? Well, first of all, I will say this: Bitcoin moves more discreetly. So you could have an example, or you could have this idea of it just kind of sits where it is, and then when it decides to move, it moves there within 2 or 3 weeks, and then does nothing for the next 2 or 3 months. That's what we've seen, in fact. I mean, these rallies by Bitcoin, they've been very discreet, and then we just go sideways for the next 2 months, right? Move it on up, and then just go sideways for months. So there is some reality of, hey, yes, the S&P's gone up, Bitcoin has not. That doesn't mean that it can't. But on the other hand, the S&P in 2019 went up basically for the entire year with a couple of large corrections, right? There was like a 7% correction that started in April, and then there was also a 7% correction that started in July. But at the end of the day, 2019 for stocks was mostly just up. And it wasn't until the resolution of the yield curve and after a pivot by the Federal Reserve and the recession that we saw the S&P go down. Now, the S&P went up in the second half of 2019, but Bitcoin did not. Bitcoin faded. So there are examples here where Bitcoin can fade even when the S&P goes up. Now, what you would be looking for would be a correction by the S&P if that's going to happen. So, Bitcoin really started to fade in July of 2019. And that corresponded to about a 7% correction in the S&P 500. The S&P continued to go up, but then again, Bitcoin continued to fade for basically the rest of the year. So if the S&P were to get some type of major correction, let's say it gets a 7% correction, let's say it goes to 4,300 or something and then gets a 7% correction, goes all the way back down to 4,000, there's a chance that could take Bitcoin below its 20-week SMA. Right? If it doesn't rally between now and then. So that is the risk, right? If Bitcoin can't catch a bid during the rally by the S&P, then it likely could fall below its bull market support band during a potential correction by the S&P. So I think that is something that we have to contend with, is if there is some type of a correction in, let's say, July, so next month, which is when it happened in 2019, if there is some type of a correction, and Bitcoin hasn't rallied sufficiently high enough above its 20-week, then it might not be able to hold the 20-week as support. Whereas the S&P could fall, 7% and maybe only just slightly go below the 20-week. It could take, crypto much further down below it. And for instance, like Total 3, the altcoin market, is already below its bull market support band, right? It's already well below it. So there's a lot of things that I think we have to consider when thinking about where we are in this, in the grand scheme of the market cycle. Now, where would the altcoin market make more sense based on cyclical behavior of crypto? Well, if we do get that secondary scare, you would likely see the dominance of Bitcoin really start to move above the range high. And then that is where the altcoin market historically has started to make a bit more sense, because by that point, most of them are getting close to the end of their local bleed on their Bitcoin pair. So the honest truth is that most of them just bleed against Bitcoin forever anyways, but they can then catch a bid going into a period of overvaluation. But oftentimes it doesn't happen until the dominance is much higher above the range highs, and often it doesn't happen until we get back to the lower regression trend line, which still we have not been able to hit. Do note that if we just kept going sideways at the current valuation, it would take us until the summer of 24 to hit the lower regression trend line, right? Just so you're aware. It would take until the summer of 24. The last thing I want to show is the summary risk metric overlaid on this total market cap regression trend line and everything. And you can kind of see like the ebb and flow from periods of overvaluation to periods of undervaluation, right? And we're just in a period of undervaluation right now. And again, going back to this idea, well, you said alts were too risky and you're now saying we're undervalued. I've said this for months. It's that they're too risky, in my opinion, relative to Bitcoin. That's why I've said for a long time, right? Like my crypto portfolio is Bitcoin heavy because I would expect the altcoin market to bleed to Bitcoin no matter the direction of Bitcoin USD, right? The whole thesis with the dominance is that the dominance goes up no matter the direction, whether Bitcoin goes up or down. I think some people think that it means only Bitcoin goes down, but no, because they've never seen Bitcoin go up and the dominance go up because they joined in 2021 after Bitcoin's parabolic rally in late 2020. So they've never really seen a rally by Bitcoin where the dominance went up. But no, this is why I've said, right, the dominance should go up no matter the direction of Bitcoin USD. So if you spend half the year going up for Bitcoin and half the year going down, the dominance should slowly go higher no matter the direction. And that way, when you look back at your portfolio a couple years later, you'll see that the altcoin market just continued to slowly bleed back to Bitcoin during that time. The last thing I want to mention is just if you take a look at, say, total 3 divided by the market cap of Bitcoin, right, you'll see that it seems like it's an oscillator, right? It sort of just moves up and then down and then up. And then the idea is that it probably comes back down. And so the altcoin market, in my opinion, still needs to bleed systematically back to Bitcoin. And then only then the altcoin market starts to become worth the risk, in my opinion. I think we'll wrap it up there. I do want to remind you that the ultimate goal, right, is to see the crypto market cap get to that $10 trillion milestone, plus or minus a few trillion, right? As we go to sleep at night, we cannot help but wonder what's a few $1 trillion among friends. Thank you guys for tuning in. Make sure you subscribe. Check out Into the Cryptoverse Premium. You can get access to these charts, and I will see you next time. Bye.